I want to introduce Sally Bruer. And Sally is just going to give a very brief kind of introductory presentation, just to put some of the things in our heads for the discussion. It's designed to be an open conversation, so if you've got questions, if you've got thoughts, raise your hand, stand up, shout out, whatever it is to get my attention, and I'll make sure that we also pick up on your thoughts and your ideas during the session. But first of all, I want you to welcome Sally and also give her an extra special welcome because her flight from London was delayed and she had to spend her night in Vienna airport sleeping on a bench there. But she still, nonetheless, is utterly fabulous. Sally Bruer.
Thank you. Thank you, Richard. I was trying to forget Vienna, but I'm sure I'll get there one day and enjoy it. Good afternoon, everybody. I am indeed going to give a brief overview about where we are currently in the market and then some suggestions about what might be shaping the future. I'm going to try very hard to compete with the music, but please bear with me. So I'm going to start very quickly and talk a little bit about the occupier side of the market, then onto the development supply side and the availability and where the market balance currently sits, how that's affecting pricing, particularly around rents, and then just a little bit about the capital market side, the investment side of the market, particularly to help understand what that shapes for the developer and investor pressure. And then, as I said, suggesting a few themes that we might pick up on as the shaping the future of logistics and real estate. So starting with the occupier. So starting with the occupier demand. So this chart shows occupational take-up, so that which is new leasing and new sales, not renewals, that which is created by new demand in the market, and broken by region. And you can see that we have reached an extraordinary level of occupier demand through to the middle of last year, reaching 46 million square meters in the 12 months to the end of June. It's the highest level of occupier demand spurred by the pandemic and particularly the e-commerce related demand, but also through the third-party logistics partnering with that demand, but also growing elements of manufacturing, which I'll come on to. We have, however, started to see that level of demand slowing down, and in March to the year end, to the 12 months to the end of March, we're down to 37 million square meters, so 19% off the peak we saw in the mid of last year. Now, what we would suggest, based on our understanding and our contact with markets, with occupiers across all of Europe, is, and it's fairly consistent from my colleagues on the brokerage side in leasing and new sales, is that this is down to a slowing down of occupier decision making. Not necessarily a lack of demand, but occupiers taking longer to make decisions in an environment of uncertainty around their own business operations, but also whether or not it's the right time to be taking a new building in this current environment of inflation and consumer restraint on all those things. So we have seen occupier demand in terms of new deals falling back, but still we see the demand and inquiries are there. The demand for space is still there, but taking longer to crystallize as deals. And the next chart would also illustrate that. So on the left-hand side, we have in the red line is consumer confidence, the blue line is business confidence, and the grey line is occupational take-up, the data that I showed you just a moment ago in the bars. What we can tell from this is that business confidence lags consumer confidence by about 6 to 9 months. So as consumer confidence turns, business confidence starts to turn 6 to 9 months later. And as business confidence starts to turn, occupational demand starts to turn 6 to 9 months later. So as you can see, the red line, we're starting to see a recovery in consumer confidence. We are at a very low level where we have seen consumers feeling very pessimistic about things, and then they're starting to feel a bit better, but they're still in a fairly pessimistic state, although getting better. Business confidence has started to slow its fall and now starting to correct. And we're starting to see, and we've seen that tip off in occupier demand. We would expect to see that continue through the next 6 to 9 months, so maybe to the end of this year, and then start to pick back up or correct, stabilize, and then start to pick back up as businesses become more confident and they start to commit to new buildings again. So we are starting to see the early signs of the green shoots of business confidence returning, and therefore we will start to see the market arresting its fall and starting to correct as we come into the end of 2023, beginning of 2024. And also just to note that on the left-hand side of this chart is a chart showing business confidence across different geographies. I could have put loads more on, but it would get very much like multicolored spaghetti and very hard to read. But we can see that most markets are behaving in a similar fashion, that business confidence is starting to slow its fall or even starting to correct over the past few months. So we are starting to see those green shoots from the occupier side. On the availability and development supply side, this chart, which does look like multicolored spaghetti, is showing availability or vacancy rates across geographies across Europe. And as you can see, over the past 7 years or so, we have reached a almost record lows where we're slightly seeing an uptick in vacancy as occupational markets have slowed down. And yet we're still seeing more product coming to market, which I'll come on to in just a minute. We are still seeing availability and vacancy at a very constrained level. So the opportunity for occupiers to find the right buildings, should they be looking for them, are still limited in their options. Occupiers are still limited in finding what they require. And part of this has also been the fact that developers have been bringing more and more product to market. So this chart shows development completions across European markets. And as you can see, we've reached an extraordinary level. To the end of last year, we're at just shy of 170 million square meters in 1 year, over the 12 months to the end of Q3. We have started to see that slow. As developers have started to feel perhaps the occupier market slowing down, perhaps there's been a little more pulling back, particularly on the speculative development. We have also seen some build-to-suit developments coming out of the market, or perhaps not completing as quickly as they might have done. Maybe the dealers are taking longer, or the deals aren't quite right for the occupiers now that they've had a longer period of time to think about. So we are seeing that slowing a bit, but that's not necessarily... in some markets, it's more acute than others. We are still seeing some markets with good supply, but perhaps it's a little more patchy rather than all markets being tight. We're seeing some with more availability than others now. One thing that has also been a challenge for developers in particular over the past several years, and plenty of you in the audience who are occupiers will have felt it as well, is rising costs. And on the development side, the chart on the left-hand side here shows some of the components for development and the cost pressures that developers have been experiencing over the past several years. And increases in costs of wood, cement, concrete, cement and plaster items like cladding, iron in particular. Iron is still up, as iron and steel products, I should say. They reached more than 85% higher than they were in 2015. They've now come down a bit, but steel is now 62% higher than it was in 2015. And let's not forget the wages and the cost of labour for construction. We've all felt that in lots of different ways, but in just the construction costs, labour has gone up 30%, almost 30% in 5 years. One positive note is that shipping costs have come down, but it's just to say that we are back at pre-COVID levels. So that's, again, one glimmer of green shoots in terms of where the cost stabilisation may be. And in terms of where costs are going, because we're looking to the future, we are expecting there to be further price correction, but there is, and we are hearing from developers that we are getting more stable prices coming back from contractors. So there is ability to be able to see through the whole construction term for buildings now, rather than the pricing changing from the beginning quote to the end price at the end of the construction. phase, but there is still some risk around pricing, particularly when it comes to high energy products like steel and concrete. So what's all that pressure both from the market and the costs doing to pricing? And that takes us on to rents. For the occupiers in the market, this is a painful chart because it shows that rents have grown massively over the 5 years. From March 2017. And I've particularly chosen the 5-year horizon because if it's a 5-year lease or a 5-year break that you're operating to, or a 5-year rent renewal that you're operating to, if you were coming to the market today or looking at a rent review now, your rents on average across all of Europe would be 34% higher than they were 5 years ago. That's on average. In some geographies and in some local markets, it can be considerably higher. For example, the Czech Republic, rents are 56% higher in Prague than they were in the Czech Republic on average. In the UK, they're 49% higher. And in some markets, we've seen more than 100% uplift in rent over the 5-year period. And this is not just loaded into the early part of that 5 years. You can see some of the slopes in the latter few years is quite extreme. If I highlight certain markets, this chart shows the cumulative 5-year rental growth in each of these markets. And in the grey bar at the bottom is just the component in the last 12 months. And for all those markets that have a very large component in grey, the majority of their rental growth has happened in just the 12 months to the end of Q1 and end of March 2023. So, for example, Krakow has seen uplift in rents of almost 90%. 75 of those 90% were in just the past 12 months. So this is not a phenomenon that seems to be easing. It is in some markets, but we are also seeing some markets accelerating in their gathering pace, particularly in places like Germany and France, which have come relatively late to the rental growth party. And finally, just a few more charts just to paint the picture on the investment side. We have seen a really extraordinary capital markets environment over the past several years, and investors have targeted so much capital at logistics and industrial. Right, I am really going to have to compete with these drums now. The investors have strong conviction in the sector, and that's why we saw the investment volumes reaching 80 billion euros towards the beginning of last year. We have seen those volumes fall off exceptionally over the past several quarters, but this is not necessarily due to the lack of conviction in the sector and the lack of understanding of the potential return. It's about pricing, and the pricing correction has come very hard and fast over a long period, and the chart on the left shows yields for different geographies across Europe with the dotted line showing the average. The yields profile has compressed to record lows. So the keenest pricing we have ever seen in the sector. And in some markets, we've seen yields for logistics and industrial property lower than retail. It's never happened before. However, in the environment of increasing national bank rates, interest rates, and financing costs, we've seen that correction in pricing come very hard and fast, particularly in the UK, where not only did we have a pricing correction and interest rate rises, we also had political instability contributing to the lack of confidence in capital markets generally. So this is not necessarily just a phenomenon for logistics and industrial. This has been across property asset classes and across other investment asset classes as well. Logistics has felt it perhaps most keenly because the compression was incredibly deep over the last 5 years. So what does that mean for the future? So if we go back to first principles and think what's driving the occupier, we think about what's driving the logistics market generally, and it tends to coalesce around these 6 items. There may be others, but as the big overarching themes, logistics is focusing more and more on data and analytics and how to use information at their disposal to think about how best to run transport, how best to run networks, and how best to use property to be able to fulfill their objective requirements. their operational requirements. Labour, of course, we're still in a highly labour-intensive industry, and in an environment of shortage, what does that mean to location? What does it mean to real estate and how it positions to be able to attract and retain people to want to work in these buildings? Technology, of course, as a partner to labour, and how does real estate need to respond to the increasing demand for power, for specification to be able to accommodate new technology? And of course, the requirement for energy feeds into sustainability. Sustainability both in the warehouse and the operation of the building, but also the way in which the building is built, as well as the connections between those buildings, the transport and the vehicles. How do we create the infrastructure that supports the changes to transport through sustainability measures? Supply chain resilience. We've all just lived through the pandemic, and we demanded so much of our supply chains, and we've seen so much about how fragile supply chains can be. And it's a great focus of many, many businesses thinking about how they need to consider their resilience, consider nearshoring opportunities, considering diversification of supplier base, and what does that mean to property and locations? And of course, all of this sits under the umbrella of strategic planning, and how do occupiers, how do businesses respond to their property decisions when they're thinking about what they need for now, the future, both near term and longer term. So that gives a flavour of where we are, where we've come from, and where we might be going.
Great. Thanks very much, Sally. And if the speakers could take a seat, that would be great. Let's just start with very brief introductions, and by brief, I mean brief. So just a quick kind of 30 seconds on who you are and what you do, just so that everybody here knows who everybody else is. Jan Dietrich, let's start with you.
Yeah, Dietrich Hempel, managing board member of GARBE Industrial.
You may need to be a bit closer, Jan Dietrich.
GARBE Industrial, investors in Central Europe and developers as well.
Great, thanks. Sally.
I'm Sally Bruer. I'm head of EMEA Logistics and Industrial Research and Insight at Cushman and Wakefield.
Brilliant. André.
André Banschus. I'm Executive Director at Verdion, and in my role I'm specifically responsible for developing warehouses in the German market.
Super. Raimund.
Hello, my name is Raimund Paetzmann. I'm the VP Corporate Real Estate for Zalando. I'm having the occupier's hat since 23 years, before for Amazon. So I always try to fight for the occupiers in this kind of panels. So looking forward to the discussion.
Great. Ingo.
My name is Ingo. I'm from Swiss Life Asset Manager Logistics.
Hello, Bert Hesselink. I'm responsible for client relationships at CTP. CTP, we're one of Europe's largest developer investors of logistics parks in Europe, listed on the Amsterdam Stock Exchange, 10 million square meters, 2 million square meters under construction.
Brilliant, thanks. Let's just start with you. Maybe let's start with you, but I mean, looking at some of the, picking up some of the topics there from Sally, I guess, how are you seeing the real estate component? What are you seeing in terms of demand, especially from the occupiers? And has that changed? Is it changing?
We see changes definitely in the market. So I agree with what Sally was saying. We see exactly the same across our portfolio. So that covers from the Netherlands in northwestern Europe through Germany all the way down to Bulgaria, the Black Sea, and then everything in between. So I think we have quite a wide range of demands from tenants, from occupiers. And what we saw 1-2 years back was mostly big box demand, mostly driven by e-commerce. What we see now is much more demand for manufacturing operations. And if we look at sizes, so like large fulfillment centers, 100,000 square meter plus, was not unusual. Now we're especially dealing with a lot of demands from manufacturing clients. Ideal size of a factory is 10 to 15,000 square meters. So demand has changed from that point of view quite a bit.
Okay, that's interesting. And Ingo, are you seeing a similar kind of thing there? What's your take on that? And we'll come to you, Raimund, in a minute around this. But are you also seeing some of that swap over maybe from the e-commerce-led side to the industrial-led?
Yeah, absolutely. I can only underline what Bert is saying here. We see a lot of demand of manufacturing, reshoring, onshoring, friendly shoring. Everything is coming back to European logistics clusters. You guys are here on one of the biggest fairs in logistics. You see all the occupiers, all the potential tenants and customers of us. And that is very delightful to be here. And we see a lot of demand for logistics warehouse. Yes.
Okay, good. And Raimund, let's pick up with you. And of course, everybody can come in on any question. We don't have time for politeness here. We've just got to share our views. Raimund, from the occupier perspective here, when you're looking at the future, I guess, what does that mean for you when you're looking at real estate? Are you thinking now about your needs for 2 years, 3 years, 5 years, 10 years? What's your sense of that, and how is that changing, and what are you looking for?
Definitely, that's the problem. What Sally is spot on with the demand. It has also to do that we are actually in the area of hyper growth, and everything what is network driven has the network effects, and it means you're in this 20-25% year-over-year growth that happened with Amazon, happened with Zalando. And of course, exponential growth is sometimes very difficult for people to understand, but what it basically means, 25% is doubling every 3 years. And of course, if you plan for this and suddenly you have 1 year with 4%, what happened last year, then the demand is dropping, or you have an overcapacity, excess capacity. But as soon as it catches up, then it comes back to the growth rates, and you will see immediately it makes a jump. And that's our challenge. It's also a little bit our challenge here in at the logistics fair. You see a lot of experts in logistics, and we are sometimes the shadow department in the real estate department. The business does not believe every time, that it takes maybe longer to deliver the buildings, that you need more 4 or 5 years. I remember, honestly, and you're sitting beside me, when I started in real estate, we could really manage to do a building in Leipzig at this time in Amazon in 14 months, from the decision to build it. And now it takes 4 years, I would say, is maybe the most optimistic to get it live, with all the planning permits and the resistance. So I'm positive with the demand, it will come back. I'm a little bit skeptic about the rent, you're not surprised. I'm not so sure whether the occupier should pay the party, because everyone else is keeping on asking for the same price. I think there has to be a consolidation. You said no politeness. I think everyone became a little bit greedy, and sometimes I don't understand it, because we started in a market, there was a factor of 14, 16 was normal, and now you can almost not build below 20. You need the 20 factor, and that's the reason why rents are going up. But it also has to do that everyone in the wanted to have a piece of this cake, and I think prices increased. Construction, they just said, okay, another 3%. It was more driven by demand and supply. So I think we need a kind of a consolidation. I agree, probably the rent will increase, but I think it cannot go on like this, because it's also difficult for the occupiers to make it work. But overall, I think there will be demand. It will be challenging to get it because we have scarcity of land. So interesting times ahead of us.
Just to say that chart shows prime headline rents. And interestingly, we are starting to see, although we are continuing to expect, and we've just finalised our latest forecasting round, and we are expecting rental growth to continue at a prime headline level across markets. However, we are starting to see the signs of more opportunity for more incentive to be offered to occupiers, but it's less consistent across markets. It's more patchy, and perhaps in markets where there is a little more supply than others. So there are opportunities for maybe it to be less all about what the developer or the investor is asking for, and maybe a little bit more in it for the occupier in the deal. But it is deal by deal. But it is starting to show signs, a few signs of that. I hope that brings you cheer, Raimund.
Can I add something to that? Yeah,
of course.
Because I like what you said about costs go up. Financing costs have gone up a lot as well. I just want to add that. And if costs go up, values go down, price goes down. So yeah, if you want to make at least a little bit of a profit, then something has to go up. That's part of the reason how we see it, why rents are going up. It's not just demand and supply, but it's also costs and values then going down.
Yeah, absolutely. But we see at the moment that the inflation rate, for example, in the US is peaking. is going down. I think it's only a question of time when the yields are coming back, maybe not when the money was for free, but when we are calculating as a project developer, we are at development yields at, let me say, 5.7 up to 6%, and we see again the market is coming back in 2-3 years around 4. That is normalizing, I think, the market. What we have seen in the last couple of quarters, I think you from GARBE, as we have seen that was a little bit too much, to be honest. No? And it's now realistic. And Sally, absolutely right. We don't think about that much to give incentives. It needs always to be a realistic offer, no? Not to subscribing it. No? Because we need a partner, because the tenants, the customers at the end paying the rent, no? And you need to look at a 10 years, 20 years partnership with them, and it needs to be a realistic, no? Your offer, your proposal to the market. No?
Yeah, but I think it's also important to understand that we are now delivering a different product. The product got more expensive to build because we need to build more into it. ESG is here one of the topics. And the buildings we are building have far more features which help driving down carbon emissions, and help also, on the other hand, rent goes up, but the cost to run the building tends to go down. So it's not all bad news for the tenant. And one important thing, ESG is not going to go away. Investors are forced to look at their investment in a more holistic way now. It's not just the rent, it's also the business model of the tenant and the way he runs the whole show. And if I look into the audience here, who is representing occupier organization? Who is renting real estate? Few of you. None? 1 finger, 2 fingers, 3 fingers. I suspect it's going to be more that are not all that honest. The point really is that you can decide whether you want to be a good or a bad tenant. And this will influence your rent in future as well. If you play along, sign a green deal, make yourself a little bit more transparent and run an ethically correct business model, you will enjoy better, cheaper rents than somebody who chooses to distribute alcohol and cigarettes and whatever, and doesn't close the shed, the doors, and emits a lot of carbon dioxide.
Yeah, I think that's interesting, the focus there on ESG. It would be interesting just to see, it's not a scientific thing, but just by a raise of hands, who sees ESG reducing carbon as a key element of their strategy going forward? Okay, that's about...
If we wait long enough, all fingers will go up, I guess.
Yeah. Well, I'm going to make a mental note of that. That's about 50%, I would say. Is that fair? 50, 60%. So we'll see what it is next year as well. Let's pick that up also, Dietrich, because I know you've been doing some work with ZIA as well. How do you see the future, particularly related to ESG and carbon reduction, in terms of the real estate provision for logistics?
I mean, we first of all, we have to realize that investors are forced by the legal framework to comply or to become more and more ESG compliant. They don't have any other choice. They're also forced by popular demand, people who want to put their savings into some sort of fund or whatever. Demand for ESG compliant product goes up, and everything else then an ESG compliant investment will probably a couple of years from now hardly sell anymore. And this is really driving all of our dealings, I would say. And that's an interesting driving force. We see also from the tenant side a lot of demand coming for more ESG compliant product. Maybe sometimes driven by company strategy and sometimes driven by the need to save on energy costs in the building. But we don't care as long as we follow the same plan there. But also on the S of ESG is quite important, and this is what drives cost up. We see buildings with more social space, we see buildings with a better equipped social space, we see buildings with all sorts of features, and my colleagues will have a long list of features they build in there, right?
We have, especially as we are Swiss Life Asset Managers, we are one of the biggest asset managers in Europe, one of the top 10 asset managers worldwide. We have really the ESG principles with us, and we have, I think, the same mindset as our customers have. If you are working with customers like Volkswagen, Adidas, Amazon, etc., they're asking for that, or Zalando for sure, no? One of the strongest
yes.
e-commerce companies worldwide with, I think, 15% growth, etc. So we are targeting at that customers, and if you have the right building in place, and you making the proposal to your customer base, the demand for that space is 4 times, 5 times oversubscribed. So you can really place green leases to the market, no? And that is for everybody's benefit, to my mind.
I wanted to pick up a little bit around, I'll come back to you in a second, Jan Dietrich. I just wanted to pick up a little bit around the energy question, because there's a much bigger focus now on logistics as well, I guess being part of an occupier or logistic company's sustainability strategy in terms of delivering energy, not just being 4 walls, but actually becoming an energy hub as well. And I just wanted to pick up with you, André, just in terms of that, because I know you've got a development at the moment. So I just wanted to pick up that, and also how that compares, I guess, with developments that you've done before and what you're doing now for things that you'll be delivering, I guess, in 5, even 10 years' time.
Yes, so it goes beyond just the warehouse itself. We are today taking much more care about things which go much more beyond the techniques of the warehouse. We have, for example, 10 years ago started a big warehouse logistics scheme in Doncaster in England, 600,000 square meters. It's state-of-the-art, high-quality product. That time we planned for sustainable features, like we have included a railport, a container railport, which saves a lot of carbon, as you don't have to ship the goods by trucks. But today we are planning in Germany a new project, similar size, and we are talking about and thinking about much more aspects. Like, for example, there is an adjacent plot where a partner company will put in a windmill park. And we are teaming up and organizing to use the power which is created there in our new park, as we expect a lot of, or much more demand for electrical power, as we won't be using any gas heatings any longer. So that's more power consumption. We will have loading stations for cars, for trucks, etc. So that changes the whole design of future schemes.
Yeah. It doesn't stop there, because as we have seen, new developments are going down. They will continue to do so, most likely, because we, as an industry, as logistics real estate developers, have less and less access to greenfield sites. Also, if a brownfield site becomes available, there's a lot of competition from other asset classes. So logistics will not be always first choice of local communities. So logistics real estate needs to change, and there's a transition we are driving also together with the German ZIA, the industry lobby organization, that logistics real estate becomes an infrastructural node rather than just a logistics place. Energy production, hydrogen production, and charging stations and stuff. But regarding this drive to reduce carbon dioxide emission and ESG as a whole, we are talking so much about real estate development, newly built buildings. This is not where the battle about emissions is going to be won or lost. It's only what we put on top of the already existing real estate is only a small fraction. So beefing up, sort of improving the carbon dioxide balance of the existing logistics real estate is far more important than the couple of buildings we add every year. And this is going to be an interesting discussion because it offers at the same time logistics real estate. The buildings we manage as GARBE alone offer some 6 million square meters potential for solar panels. So we have now our own business unit to cover this. And it's not only the rooftops. The older logistics facilities have, really large and ugly walls. There's no glass in between. That's the later buildings which have glass in the facades. So there's a lot of square meters to be covered on top of the 6 million. And this is replacing whole power plants as suppliers of electrical energy. And this is what we have to politically also drive, because the logistics industry and in Tau, the logistics real estate industry is not very well liked in the general public and in politics.
Yeah, and let's pick that up from your point of view, Raimund, as well, just in terms of that discussion around embedded carbon, but also energy, because obviously it varies depending from occupier to occupier, how much the real estate component relates to their sustainability versus transportation, for example. So I suppose, what's your take on that?
Don't get me started. There's really a lot. First, I always like to make the comment when we talk about ESG, we always talk about environmental. There's also the social and the governance aspect. And just looking around here, look, the diversity terrible here. In this, and that's something we have to face. We are not talking only about environmental, we also have to change the way we do it, how we represent it in the company. So that's a big thing. And of course, environmental is the key, because I am a strong believer. There may be a few people which still doubt the climate effect. I think it's there, and we have to do something. If we don't do it now, independent from any financing regulations, we have to start. We have to take it serious. And of course, building is 38, depending how you do it, probably 38% of the carbon footprint in the world is real estate industry. It's running buildings, it's building buildings, also the embodied carbon. We rarely speak about embodied carbon. You have this nice picture on the inside here with the wooden frame. So we have to think about how we build buildings in the future, make them more sustainable. And of course, this energy aspect, it should be normal, that everyone is building a new building, not having solar panels on the roof should be punished. That's it has to be like this. We have to produce the energy. We have to start also for trucks to provide the energy. So that's just a given. We have to do it. And Jan Dietrich is right. We also need to look into the existing buildings. How can we actually add it? So for us, it's really a very important part, and I think it should be for everyone. There is a big component to change.
Great. And André, you wanted to come in on that.
That's absolutely the case. What Raimund says. And today I have seen a calculation which compared, for example, a normal older warehouse building with a gas heating system and a totally new one with new insulation and air heat pump. It costs more if you build it, but if you analyze the costs over 10, 15 years, it is not that much more. So we have to not only look at the net rents, but also at the side costs you may have over the years.
Yeah. Sally.
I was just going to say, we also, picking up on what Jan Dietrich said about, existing buildings, it's considering the continuing commerciality of existing assets. What works in the building and what doesn't. So what needs to be upgraded, what needs to be fixed, and what doesn't? What actually still fundamentally works? Is it the location? Do the yards still work? Does it need to be knocked down and built again? Or can you retain some of the building and not have to then destroy and recarbonize the building again through the construction process again? What can be retained? What is still commercially appropriate? Not all buildings will be. But some still have commercial application, albeit with some upgrade, and the ability to be able to create sustainable energy on site or capture energy in some other way using battery tech or something like that. But there have to be solutions around existing assets because there are a lot more of them than there are new buildings. So we have to think about the commerciality and the appropriateness for future operation and the sustainability, on the environmental side and the social side. There is an awful lot to be said, for having buildings that people want to work in, especially in an environment of constrained labour availability. You need to have good buildings where people want to come and work. Interesting, engaging spaces that allow them they don't have to drive off campus to go and get lunch, or they don't have to, they can walk around the site and enjoy a pleasant walk. All of that comes into the built environment. Both the occupier's responsibility to provide that space for their workers, but the developer and the landlord's responsibility to create spaces that the occupiers want to pay money for as rent.
Can I? That's exactly what I'm trying to connect, because we're sort of the real estate business here. In my role, I'm speaking to our clients, the occupiers, all the time. And what I find, when I'm even myself sitting in an audience like you all sit, and I hear real estate professionals talking about ESG, there we go again. So what I did, I was sitting down with our head of ESG. I said, okay, let's write down what our occupier clients, what logistics companies, etc., what do they really need? So just tell me, what can we deliver so that we help our clients to hit their KPIs? And then we did an analysis. We looked at all of the deals that we did over the last 12 months. And then we had a look, okay, who is seriously interested in ESG? Yeah? And I swear that it was only about 20% of companies that were willing to pay more money for better rated buildings. But this is increasing. So in this audience, it was already 50%. So it's not an excuse for us not to do it. We're doing it in everything. Just we as a real estate industry need to do a better job at explaining how ESG can help our clients to hit their KPIs. And there's 5 things. The first thing that was very important for our clients is building certification. That's easy for all of us. And then what we talked about right now is energy. So reducing carbon footprint. So it's like producing energy locally, more energy efficiency, reducing carbon footprint. Then the third thing was reducing water consumption. 4th thing, e-mobility. We spoke about that as well. And the 5th thing was biodiversity, increasing that. So how we now go to market is, okay, this is what we can offer you. Let's talk about how we can help you to meet your KPIs related to ESG. So then we can really make it real.
Maybe just one thing, if I may, before it's too late, with Sally, one request from the occupiers view. I think we have to change the way how we finance existing assets, because the problem is, if you want to make them future-proof, that they are not stranded assets where the investor has actually a huge interest in. The problem is, we all know how it works. The funds do not have the free capital to invest, because it's just a holding vehicle. And that's something what we need in the future. We need something, because it's a nightmare if you try to approach now. We have actually a gas exchange program that we are approaching some of the landlords and saying, we want to put in heat pumps. There's just no money available. They're saying you can do it, but you pay. They say, why should I pay the heat pump for you? You have the stranded asset. But I think it's just a systemic problem in the moment. That there has to happen something, and there needs to be an initiative, if you talk about ESG, how we finance this in existing assets.
Yes, absolutely. I think coming back to Sally's point, existing stock. Our main occupier, Bert, is in existing stock are third-party logistics as well in new developments. And we see at the moment that even the manufacturing scenery, who has now the contracts to the third-party logistics, that they have capex budgets to get this ESG conform. So if you have an older stock building and there's maybe not a solar panel or something like that on, the manufacturing scenery will provide capex budgets on this. I've begun development in logistics 20 years ago. Even with stock-listed companies, we had a budget for ESG at that time of 100,000 euros for each development. Jörg, our construction director from Swiss Life Asset Managers, in our new developments, we have nearby 10 to 15% on the total investment cost are related to ESG. Geothermy, solar panels, heat flooring, everything is in it. And you need to find a customer who is happy to be with you. And that is, I think we see that in the scenery at the moment, that everybody is on the same picture to do so.
Yeah, I mean, it's quite interesting. Solar panels solve a lot of problems for existing real estate. We are a specialist in so-called core plus and value add. So older buildings, if you like, obviously not with latest heating systems and so on. And if we want to avoid the stranded assets issue, so end up with an investment which we can't sell anymore because it's not ESG compliant and especially not carbon dioxide compliant, it often solves the problems for more than 2 decades to come if we put solar panels on top. Not even on the walls, but just on top. We're running model calculation and we are now converting this real estate. And this doesn't cost the tenant a single penny because this is a separate investment. And the opportunity for the tenant is to make use of the green electricity which we are producing, also impacting quite positively on the overall carbon dioxide footprint of the tenant as well. So there's a lot of free lunch to have. It's not all that costly and bad and everything. The only thing that the tenant has to get used to is that we need more transparency regarding his dealings with energy consumption and so on. And this is something where the majority of our real estate is single tenant, single user environments where the electricity and other media is bought by the tenant directly. It's not bought via us as an owner. So we have no transparency, but it helps us in order to secure the value of the investment if we know. This is what the green leases are about. They are about transparency regarding energy consumption. So if the tenant plays along, there's a lot of good things to come.
Okay, good. I wanted to pick up a little bit on supply chains, what we expect to see in the future. We've obviously had a changeover from COVID, and now we've got geopolitics creating differences as well. Maybe let's just start with you, André, on that. What's your take on supply chains? There's a lot of focus on nearshoring, friendshoring. How do you see that developing?
Yeah, I mean, we over the last years we have seen that there's less and less land available. So in the past, 20 years ago, when there was a project to be built, a build-to-suit project, you were just designing it and then you looked for land and you found it. And today it has become much more difficult in Germany. So you have to use brownfields in some areas because there's no greenfield available. Municipalities don't always like logistics, and they don't allow logistics to be built. So in terms of supply chain, I think it might change a bit, and we will see the movements out of the big areas which have been established over years, and we will have new areas where you have bigger logistics areas where they are wanted and they are well connected to the infrastructure, to motorways and other infrastructure.
I'll come to you in a second. Okay. I just wanted to bring you in, but because you've obviously got quite a big footprint in the CEE as well. And there's been a lot of discussion around nearshoring, friendshoring, more kind of industry being set up there, movement away from China. What's just briefly your take on that? Do you see that as a growing driver of demand?
Yeah, definitely. So the new locations are in Central and Eastern Europe, we see, but not only. So we acquired a big portfolio in Germany last year, and the clients that we have there, many of them are producing things. They would like to grow as well. And a big reason for that is that production is increasing in Europe. So the clients we speak to, they would like to produce in Europe for Europe. The new demand is coming from other regions. Everybody talks about China, but can also be other parts of the world in order to de-risk supply chains. They're being told, or they are deciding to produce in market for market. Also goes the other way around, yeah? It's not only going one direction to Europe. So we see an increase in demand driven by de-risking of supply chains. We see it across Europe. It's not just Central and Eastern Europe, although Central Europe is super favorable. Very cost-effective in terms of labor. The investments that were done in infrastructure were much higher in Central and Eastern Europe compared to Western Europe, so connections are great. And yeah, permitting is increasingly difficult, especially in Western Europe, also in parts of Central and Eastern Europe, but it is still faster, although there are differences between the markets.
Can I just, I've been looking at nearshoring recently, and we'll have something coming out in the next few weeks, by the way. But the drivers for nearshoring are much wider than perhaps we understand, and cost is one of them, but there are a number of others, particularly related to geopolitics and the support that can be delivered through governments seeking to secure types of industries, particularly ones where there is risk associated with not having them in geographies. But also resilience and, flexibility as well, the ability to move swiftly, the ability to be able to diversify supplier base, and also things like sustainability and impact. So particularly in things like textiles and apparel, they have a huge focus on their oversight of their production locations, either their own or their contracting partners. And for example, they conduct hundreds of, major apparel retailers conduct hundreds of audits a year on their contracting manufacturers to ensure that they are upholding the standards of labor welfare, staff welfare, environmental conditions. That's an awful lot harder to do when they're on the other side of the planet than when they're close by, with the flexibility to be able to respond to market demand as well. So there are an awful lot of drivers, and that I absolutely agree with you, Bert. I've been surprised by how wide the opportunity is. Yes, there are opportunities in lower cost centres, particularly in the CEE and Turkey and Northern Africa like Morocco, but there are lots of opportunities through established markets in Western, Southern and Northern Europe, particularly around industries going through transformation like automotive and high-tech machinery, electronics, that kind of thing. So there is an awful lot going on but I would absolutely suggest that nearshoring is happening and that it's gaining momentum.
Yeah, there's a lot of opportunity, and that adds to the demand which is already existing. And maybe some of you might have been impressed by the square meters added each year, newly built logistics sheds. I'm not that impressed, I have to say, because if I look out of the window of my office in the Hafen City in Hamburg, I see, many, many square meters of former logistics space, which is now covered by residential and a shopping center and whatever. So what we have to realize that in at least the more densely populated areas in Central Europe, we lose a lot of logistics real estate as we go along. Because we are so much in competition with other uses, so the supply really doesn't grow that much, at least not as much as suggested by some of the figures.
Raimund, yeah.
So also from our perspective, it definitely, there was a supply crisis. Actually, at the start of the COVID, it was the first time almost, you could see that there was a demand and supply crisis. It started at the beginning this uncertainty. Then of course we had in China the ports were closed, and later this canal thing happened in the Suez Canal. So really difficult times. And I'm pretty sure you can see it. There is this nearshoring. We're also looking how can we make the supply chains more resilient. On the other side, I think there's a high dependency. I would not bet on it for a long-term trend, because people tend to forget. So as soon as situation stabilizes, maybe the cost controllers get the over, they win again and say, okay, we have to look into it. So there is a trend, but I'm not sure whether that's for the next 10 years, and it depends probably also how
After all, Raimund, it has been like that after 9/11 too,
Exactly, and it's also interesting what we consider, and it's almost impossible. What would you consider as a geopolitical safe area? You have issues in Turkey. Everyone is speaking about the election in Turkey. What is happening? Like it is a general election. What is really changing the course of the world? Or you have Hungary. So there are many places where you say, would you have considered 5 years ago as absolutely safe haven to go there? I'm not saying it's not, but it's just really difficult in this environment to find the right locations. And CEE, I guess Poland and Czech Republic is definitely something, but also somehow disrupted. What happens actually to the Silk and to the Belt Road? If Ukraine and you have all these issues, can they do it with the trains and with the transport? So interesting times. So definitely. We will see this as additional pressure on the market for the next 5-6 years, nearshoring, reshoring, and definitely in some critical areas. I think pharmaceutical, there's no way. I think it has to come back. Everyone realized how dependent we are.
I think, Raimund, any challenge that has been appeared now during the coronavirus or any other crisis, the relative power of logistics houses has been even more stronger, Sally, is giving what we have seen in your great research pieces. And Jan, if you look at modern stock in Europe in comparison to our peer markets, that is the US markets, even there's 4 times more modern stock in US markets than in European markets. So there's still a lot of room where we can grow in.
Good. A room to grow is a good positive thing. It is now 1 minute past 3, which was, 4 in fact, which was our time to finish. If anybody has a question, now is the time to ask it. I'm going to scan the room for approximately 5 seconds until I get to the end of this sentence. If there is no hand up at that point, I will ask a very last question, which is, what is going to be the biggest trend that you are going to be focused on, that you think is going to influence real estate markets for logistics? You can only choose one, I'm afraid. So, Jan Dietrich, what is it?
The biggest challenge right now, at least for the next 2 quarters, is still supply and demand and investment, sort of finding the way, agreeing again on pricing levels. But that's going to go away in half a year or so. So the market will come back.
Great. Sally?
Long term, it will continue to be ESG. And every part of that, not just the environment, but the social and the governance, and ensuring that buildings are well integrated into operations, but the planet and communities as well.
Okay, André.
It will be developing autonomous parks with own energy production and consumption. That's what I think will be important for us.
Okay, good. Raimund?
For me, it's land scarcity, so that's the biggest challenge, because it's not, at least in Europe, is limited. And ESG, of course, but ESG is something we hold in our hands. So we are the owner of the destiny if we do it right. But land scarcity is the biggest challenge for me.
Raimund, I can only underline what you are saying. I think the core competence of any developer investor is how do you get smart land banking? How you can make a trusted partnership to municipalities, to mayors, to your partners, to third-party jurisdictions, that you are the right partner to get the land banks, to make your destination.
Great, Bert.
Yeah, the solution is park development, but for me the biggest trend is de-risking of supply chains.
Okay, good. Thanks very much. Thank you to everybody for being here. If you're watching it on demand, thank you very much for watching. And if you could join me in thanking both yourselves for being here and the panel, that would be great. Thanks very much, everybody.